Hello everyone, my name is Lamar Baxter. I'm the Director of Business Development with AccuPlan Benefit Services. I'd like to thank everyone for taking time out of their busy day to join today's webinar. Today's webinar topic is investing in real estate with a non-recourse IRA loan. We're going to be talking about how you take advantage of using your self-directed IRA to invest in real estate, once again using a non-recourse loan. Today's presentation will be co-presented with the gentleman from First Western Federal Savings Bank, Mr. Roger St. Pierra. What we'll be covering in today's webinar will be the following: what is a non-recourse self-directed IRA loan? 6 reasons to buy real estate now with your self-directed retirement plan. How does it work? Property types. The benefit from a non-recourse financing. What are the rules relative to IRS Code 4975? What are the qualifications, underwriting guidelines for such a loan? Loan terms and LTVs. And we'll briefly cover unrelated debt finance income tax, also known as UDFI. Before we get started, I'm going to go over our disclaimer. And once again, as all the webinars and any presentations that we will usually promote is used for educational purposes only, so it's really important that you consult with your tax and legal and professional advisors as relates to any advice you need to instruct you on how to make any types of investment. So with that being said, I'm going to read off our disclaimer. AccuPlan Benefit Services and its affiliates do not provide any investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. This webinar will be recorded, and within the next day or so, we're going to go ahead and send out a playback link to all registrants. Any questions you may have, please feel free to enter your questions to the chat feature within your screen, and towards the last 10 minutes of the presentation, we'll go ahead and answer the questions. So without any further ado, I'll go ahead and pass over the screen to Mr. St. Pierre, and we'll go ahead and get started.
Thank you so much, Lamar. I do really appreciate the opportunity to spend some time today to help educate potential clients and future clients, existing clients of AccuPlan, about the power of using leverage in your self-directed retirement plan, and how that can be used in conjunction with your funds to purchase some real estate. And that's where we come in. We are First Western Federal Savings Bank, and as Lamar mentioned, I'm Roger St. Pierre. I'm the Senior Vice President of First Western Federal, and we are a portfolio nationwide lender for IRA loans. And what that means is that we keep every loan that we make on our own books. Each deal is reviewed individually and a decision made on its own merits. So we lend across the country for the purpose of folks with their self-directed plans buying real estate, and we do that coast to coast. We also have a disclaimer, and that is that First Western Federal Savings Bank and its employees are not accountants, nor are we investment advisors, and we're not qualified to provide advice on IRA rules, regs, or eligibility requirements. And I would ask that you consult your tax and investment advisors if you have any question regarding those kinds of issues, as we are the lender, but we don't get into the rules and regs and those kinds of things. We have been actively working in this market and in this field as a national lender for over 5 years now, and the timing of this is very good, particularly for all you folks out there who are wanting to use a portion of your retirement funds to diversify and move into real estate. And, you know, with the meltdown, so to speak, of the real estate market here 4 or 5 years ago, it's actually created a lot of opportunities for those folks, particularly like you, that have money in your retirement accounts. You know, a lot of folks may be experienced investors in real estate personally, and they're now realizing that, yes, they can now do this with their retirement plans as well. And so a lot of times folks who didn't know they had any access to additional funds thought that that was probably all they could buy in terms of personal real estate. But guess what? Now you can buy real estate with your own self-directed retirement plan. And if you only want to use a portion of your funds, you can pair that with a loan from our bank and now purchase real estate. So again, the timing is very good. Prices have come down from their highs of back in 06, 7, and 8. And so now the timing, we believe, and I think most experts are now saying nationally that it's a very good time as the real estate market has turned the corner and is now appreciating again that now is a very good time to add a piece of real estate to your investment portfolio. So there's reasons to do that now, and one of those is, one, it's a tangible asset. You can see it, touch it, feel it. It's not like a big board stock that may go up and down, and the company may go out of business, the asset may change in value. All that is well beyond your control as an investor, whereas if you buy that house or duplex down the block from you, you can see it, touch it, feel it. It's not going anywhere, and that asset's going to be there for the long term. It offers a real asset diversification. Obviously, it is wise to diversify your investment portfolio, and to have some money in stocks and mutuals is a good thing, but also is a good thing to diversify some of your retirement assets into real estate as its own asset class. And that asset class within the retirement plan is pretty powerful because the profits from that are not taxed, nor are the rental incomes that you might derive from that. So there's opportunities both for capital appreciation and rental income to grow your retirement plan. And there's a lot of choices in today's marketplace because there were so many foreclosures. They have created a lot of opportunity for properties that may just need a little TLC to make them rent ready. They may not need much at all, but there's a lot of choices in today's market with all the foreclosures and banks taking properties back. Those are now good opportunities for investors to go in, and we've been doing a lot of financing of short sales and foreclosures for clients that are buying stuff at very good prices. And that's the next point, these affordable prices, because of the shine that came off of real estate through the real estate bubble melting down, prices in many markets are probably 20 to 30% less today than they were 4 or 5 years ago, even with some appreciation that we're now seeing. So the entry point on buying some homes, duplexes, rental properties, commercial properties, what have you, is a lower entry point today than it probably was back in 07, 8, or 9. So the rental return rate now is better than it was years ago as well. So you have better cash flow. And the next point is you do have the potential for upside capital appreciation as that property increases in value. That asset is going to increase as well. If you ever go to sell that, you have the benefit of the capital gains being shielded with your self-directed retirement plan. Lamar, if you'll cue the next slide, we can see that there's some due diligence, though, that is probably wise to perform that you may not have on other kinds of assets, although you obviously need to do your due diligence if you're picking stocks or mutual funds and so forth. But in real estate particularly, you do need to do a lot of due diligence. And that just means that not just because, you know, a property price may have a lower price point, that's a good thing, but that doesn't necessarily make it a good deal. There may be all kinds of issues with that piece of property, from potentially foundation issues to other issues, repair issues, that you need to get at and make sure that the property you're buying is a good one, and that it's not some of those things that can happen in real estate or there that you end up having to repair and spend a lot more money down the line. So again, when you're buying a piece of property, make sure you really examine it closely. You may even want to do what would be called a home inspection, by a professional home inspector just to ascertain the condition of things like electrical, plumbing, HVAC, and things like that. And that brings us to the next point, and that is that a lot of homes you buy nowadays, or in condos, for example, they might be in an HOA. And some of the things that I look at with the next slide as an example are the HOAs have a budget, they have expenses, it takes money to run those HOAs, and if you buy a condo or a townhome or even a home in a perhaps a gated community, golf course community, you're going to have what's called a homeowner association. That homeowner association is in charge of paying all the capital improvements to the outsides of the buildings. They often have common area maintenance. They have clubhouses. They may have tennis courts, swimming pools to maintain. And you want to be sure that that HOA is sound. So I ask every investor who's buying a property within an HOA to get us 2 years of financials. Let's look back at 2011 and 2012 and see what a balance sheet looks like. Let's see what a profit and loss looks like on that entity. Because we do want to make sure if you're buying and spending $150,000 for a property, that the HOA where that property sits is sound, that the HOA itself is not going broke. And there definitely has been some hardship in these HOAs over the real estate meltdown, because folks who have a house payment, you know, you may not know this, but typically taxes and insurance are escrowed as a part of somebody's house payment. And so those items get paid, but HOA fees are not. So oftentimes a person who's going through some financial stress, the property may wind up in foreclosure. Well, they're going to stop paying that HOA fee long before they stop paying their house payment. So the HOA entity itself then becomes short on revenue. If you get 10, 15, 20, 25% of the owners in there not paying their dues, then it adds up, and it's incumbent on the rest of the people in there to make up for all that revenue that's lost. So you may see special assessments. There may be extra legal expenses that the HOA has to pay to try to collect some of these HOA fees. So, you know, word to the wise, make sure that that HOA that you're buying in is as sound as the piece of property that you're buying within it. Because just because you're buying what looks to be a nice piece of property, you want to make sure that the outside of the buildings and everything else is maintained so that it's there for the future. So again, take a good look, ask the question, find out what the financial shape of the HOA is in. The next thing that you folks should probably take a look at, and what we look for in terms of non-recourse lending, is some of the issues on what a non-recourse loan is. And the next slide will show those issues and what we look at. And you know, when you're buying a piece of property, you want to target a piece of property that is easy to rent. What we as a bank finance are long-term rental properties. And you want to make sure when you're buying a rental property that your potential rental pool, A, has fairly short commutes to job centers, that they have that you've got not long commutes, that again, property is in a good part of town, all those kinds of issues that would make a good rental property. You want to make sure that the property you're buying is one that's close to shopping, some amenities, things like that that the potential renters are going to value, and that's going to help you keep that rental property filled. So again, when you're looking at rental properties for longer-term buy and hold strategies, you want to make sure it's going to be in a desirable part of town and it's easy to rent. That would bring us to the next slide, and that is, what is a non-recourse loan? And you've probably heard about it a little bit, but non-recourse loans in the IRA, self-directed 401k world is a loan that's secured entirely by the collateral. There's no recourse from the bank to collect the loan from the person. The person does not guarantee the loan. It's the retirement plan itself, or solo K, or if you have a LLC as your entity. Those kinds of entities are the borrower, they're the owner, and they are then the borrowing entity. So the retirement plan is the entity that borrows and buys and takes title to the property, not the person. So again, make that distinction, and when we do a non-recourse loan, that loan does not show up on your personal credit. It is simply a loan that the entity itself has, and it's no reflection on your personal abilities to pay. On the next slide, we have a issue and how we underwrite these things, or how, you might ask, how does the bank make a decision on whether or not they're going to approve the loan? Well, the criteria is quite a bit different, actually, than what you might find out in the personal world. One, the down payments are substantially more. You're going to find in this non-recourse borrowing world that 40 to 50% down payments are the norm, not the exception. And realizing that the lender has no ability to collect from you as a person, only the property can pay the loan back, you can understand that the lender is going to want more quote-unquote skin in the game, or more down payment from the borrower. So plan on having about 40 to 50% down. Your closing costs, which you would have like you would buy on any piece of property, coast to coast. You're going to have appraisals, title companies, closing agents, those kinds of things. So you're going to need to set aside some money there. And then you should have some liquid funds left in reserves. And we like to see a minimum 15% of loan amount still left in your plan. It doesn't have to be just sitting in cash. If you have another kind of a liquid investment that you like and are getting a good return on, fine. Keep that money working for you. But we as a lender are going to want to make sure that you have 15% of the loan amount still in a liquid investment that you could liquidate and use to make a repair on the property, or if a renter moves out and you go a couple of months without income, you want to be able to continue to service the debt and not run into issues. So that 15% is for your protection as well as the bank's. And then how do we look at the cash flow? Because that's really what's going to pay the property back. And that is, we do a debt service calculation. And I'm going to get to that on the next slide in just a second. But that debt service coverage of 1.25 or greater means that the property's throwing off positive cash flow. So we're going to look at, one, does the IRA have the money in terms of down payment, closing costs, and reserves? Two, does the property throw off positive cash flow? And it's pretty easy for us to run a debt service coverage analysis on it, and you should, as an investor, do that too. Is the property a good one? I mean, is it a solid property? Doesn't have a lot of deferred maintenance, things like that, in a good area? And lastly, does the transaction make sense? Does it make sense not only for the IRA owner and investor, does it make sense for the bank? So those are the four issues that we look at. And on the next slide, I'll tell you a little bit about what that debt service coverage ratio means. And a lot of the homes and properties that we're financing over here at First Western Federal have never been rental properties. A lot of investors out there purchasing foreclosures. They've never had a rental history in them because they were owner-occupied. So you might ask, well, how do we plan on cash flow? Well, I have you, the investor, get us a pro forma of what you believe the income will be from rental income, and get us the expenses that are known to that specific property. such as taxes, insurance, maintenance, any HOA fees, any management. And so then we'll run it through this basic worksheet as you see before you. We'll take your gross rental income, and in this example, I'm using a $100,000 purchase price and a $60,000 loan, and we're going to make the assumption that the rental income is $1,000 a month. So we take the gross rental income for the year, 1,000 times 12, and that's 12,000. We plug in a vacancy factor, and you should too, of 7%. And that basically represents 1 month a year when the property will be vacant, and it's fairly conservative. Pretty hard to imagine that every property is going to be full 12 months a year every year. So again, we're going to plug in an expense for vacancy. We use taxes, whatever they are, insurance, whatever they are, maintenance. And then if you're using a management outside company to manage it, maybe you live in a different city than the property is located. Or maybe you don't have management experience in rentals, so you hire a management company. Again, plug that number in. So now you take your gross rental income, subtract these expenses, and now you get net operating income. And that's the key element. You'll see that in a lot of real estate investing terms is net operating income, and that's the income that property will produce after all its normal expenses. And so then you take your net operating income for the year, divide that by what your principal and interest payments would be, and that gives you your debt service coverage. So we took $12,000 in income, we subtracted out all the expenses and ended up with a net operating income of $7,360. We determined that the principal and interest payments on a $60,000 loan would be $3,900 a year. So $7,360 divided by $3,900 equals a debt service coverage ratio of 1.89, or in other words, 189% of the loan payments are covered by income. That's a good thing. So the stronger the DSCR number you have, the better cash flow it's producing. And again, we like to see something better than 1.25. On the next slide, you'll see that there's some issues that are going to be involved whenever you're borrowing money, and that's a tax called UBIT, and I'll get to that. The next one, what is UBIT? Well, UBIT, as the IRS deems it, is an unrelated business income tax. And back in the 50s, in order to level the playing field between nonprofits who were potentially participating in income-producing ventures, like universities and potentially churches, other nonprofits might be operating a business. And in order to level the playing field between those entities and private industry, they said, you know, if you folks out there who making money through unrelated activities isn't your normal business, we're going to tax you on it because everybody else has to pay taxes. So Congress created what is called unrelated business income tax. And that's a tax that's basically levied on the profits of businesses that are run by nonprofit entities. And how that relates to your self-directed IRA is that if you're going to use somebody else's money, in this case, if you're going to be borrowing some bank money to buy an income-producing asset, the IRS code says you're going to have a potential tax bill on the amount of money that was borrowed. And this next slide gives you an example on how that works. UBIT is based on what the debt is. So if you have a 50% loan on a given piece of property, then potentially 50% of the net profit from that investment is going to be subject to UBIT, and that's at trust tax rates. On the next slide, I give you an example of what that looks like. So let's say that you bought a $500,000 commercial building, and you put 50% down. So that means that they had there was a $250,000 loan on it. And with 50% of the net profit being produced by the bank's money, not your own, the IRS says, well, then 50% of the net profit is going to be subject to tax. So you can go through and take your whole calculation, take all your income for the year, subtract out all your expenses. And in this example I'm showing you here, if the net profit was $40,000 for the end of the year, and you had a 50% loan on it, then $20,000 of that $40,000 profit would be subject to tax. And it is taxed at trust tax rates. There's a special form you fill out. It's called the 990T. That income and that IRS form does not show up anywhere on your personal tax return because, again, you're not the borrower here. Your IRA and your IRA entity is the borrower. So, yes, trust tax rates are a little bit higher than personal tax rates, but by the time you take out depreciation and all your other expenses on a real estate investment, most of the time on paper we don't see a whole lot of profit. So if you're not showing a paper profit, you're not going to have any tax obligation anyway. But just be aware that UBIT is a real item. It's something that you ought to be aware of. You want to visit a little bit with your tax accountant and make sure it's a tax accountant that knows IRA and retirement plan rules, because they're substantially different than personal tax returns. And you just want to make sure that you're talking to an expert in this field and not a tax expert that is familiar with personal stuff, because they're not related and they may not have a full knowledge of what that's about. Next slide touches base on the kinds of properties we lend on. Now, a lot of times, folks, because of the comfort level and the size of the amount of funds in their retirement plan, are going to buy residential properties, and that's probably the most of what we finance, are single-family homes, duplexes, and apartments, perhaps. But you know, what I see generally in the industry is people who are comfortable owning rental properties personally, and they have 2 or 3 of them already. Now they want to add a couple more in their retirement plan. Most of the time they're buying residential properties, and they may be right down the street or they may be across the country, but residential properties, because of the price points, make a pretty easy entry point into the real estate investing. Again, if you find the property for $150,000, we'll lend 90 of that 150, so you'd only need 60,000 down, for example, on a $150,000 asset. And that $150,000 property can produce some pretty good returns for your retirement plan. We also lend on commercial properties, so whether that's maybe a commercial building, an office warehouse, a mini storage, it might be something like a ground lease. Maybe you buy a ground lease with a Dollar General store as a national tenant. But commercial properties, they have oftentimes longer-term tenants in them. You can get 3 to 5 year leases on them. They can be a little more stable investment than a residential property. And another example of something we would do is farms with income. You may not be the farmer, but you may own a farm and have an operator lease that farm ground from you. Let's say that there's an operator and you buy the farm next to that one, and that operator can see that leasing out your property makes sense. They can run the crops, they can do all that, and you just collect an annual lease income. We can finance farms with income. So the bottom line is any kind of basically income-producing property, whether that be residential, apartments, commercial, farms, we lend on it. So whatever your area of expertise, or I guess I would say comfort level is in real estate, we should be able to handle it. There's loans available to do that. And we have been active in this business for over 5 years, lending coast to coast, and that's what I do every day. So feel free to contact me or our company if you get to the point in time where you want more information or you're actually ready to make a purchase. And I guess one thing I would just say about that is when you're going to write a purchase agreement on a piece of property, make sure that you write the purchase agreement in the name of your plan. And so if your plan is AccuPlan for the benefit of you as a person, that has to be the way that the contract's written. It's not in Bob Smith. It might be AccuPlan FBO, Bob Smith's IRA. So again, be sure when you're dealing with your realtor, you're buying a piece of property, that you write up your contract in the name of your retirement plan, not you personally. So those are some real key, I guess, issues, thoughts. Lamarr and his company will do an excellent job of setting up a plan for you, and then when you're ready to make a purchase, now you have an entity that's ready to go that we as a lender can deal with as well. So again, make sure you have your self-directed plan in place and funded before you go out and start making offers, because offers can move pretty quick if they get accepted. Now you have 30, 35, 40 days to close on it. You don't want to be now trying to move money from another plan into your other one. Get that done ahead of time. Have the money there, have it ready to go, your entity's ready to go, so that when you go shopping for a property, you're in position to make a purchase. So, these are some of the keys. There's obviously a lot more questions you might have, but feel free to contact our bank, First Western Federal Savings Bank. You can ask for myself. Any question or issue, please don't hesitate to get a hold of us. And I again want to thank Lamarr and AccuPlan for the opportunity to speak to you folks today and offer some insights into non-recourse lending and how you might add a piece of real estate to your portfolio.
Okay, well, great information, Roger. I'd like to thank you for sharing this information. So we're going to go to the next segment of this webinar and talk about the self-directed retirement portion of how the actual self-directed plan ties into a non-recourse loan, and usually what your plan options are, account types and whatnot that you have available to you. In addition to today's webinar, we actually try to make sure we do these pretty much in the same time frame in terms of the non-recourse loan webinar, as well as the webinar on UDFI and UBIT. And that was a webinar we had done last Thursday with a CPA. So for those who have more in detail questions on getting information on unrelated debt finance income tax as well as unrelated business income tax, I can actually email you the webinar playback link for you to listen to that at your leisure. And if you have any detailed questions, feel free to contact the CPA Lorraine Evans, who actually was the speaker on that webinar last Thursday. So what I'm going to do is go ahead and move into our next segment of the webinar. And as I mentioned in the beginning of the webinar, is that we'll have a Q&A session towards the very last 10 minutes of the session, in which I'll go ahead and read off the questions relative to those that come in through the chat feature, and both myself and Roger will answer the questions relative to what we covered in today's webinar. So once again, my name is Lamar Baxter. I'm the Director of Business Development for AccuPlan Benefit Services. I'm going to be once again covering the self-directed IRA, or so to say, the self-directed component, using your self-directed plans for example, using a non-recourse loan. I'm going to be talking about different types of investments in addition to real estate, just to kind of give you an idea in terms of which broad scope you have available to you using a self-directed plan. For those who joined the webinar late, I'm going to read off our disclaimer once again. We usually promote educational seminars and webinars, so none of the information we're conveying today is to steer you towards any particular investment, nor to give you any investment advice as it relates to tax, legal, or financial. It's really important that you consult with your tax professional, your legal professional, and any other financial professionals for any advice relative to the type of investments you're considering. AccuPlan is a national company. We are an administrator as well as a custodian for self-directed IRAs as well as 401ks. We pride ourselves in expertise on low-cost and quick service of self-directed plans. We have a very well-maintained staff, or very strong staff, should I say, of tax, legal, and IRA professionals as it relates to making sure we give you quality service and information as it relates to making sure that your self-directed plan is compliant with IRS rules. One of the things I like to cover in my presentations is to really give you an idea why a lot of our clients are seeking to look at the self-directed plan. I'm just going to look at some of the bullets here as it relates to some of the statistical information that usually come across our desk, and we want to definitely share with both prospective clients as well as existing clients when it comes to a self-directed plan. It is estimated that 10,000 baby boomers per day will turn 65 for the next 20 years, and of that segment of the population, I'd say up to 75% are not in a position to retire at the age of 65 and beyond. Most will be forced to continue to work beyond the age of 65, provided that their occupation or their employer will allow them to work beyond the age of 65. Most of their population will also face skyrocketing health care costs and diminished Social Security benefits. A lot of these benefits that were around for 2 or 3 generations prior may not be there for us. So it's really important for us to look at alternative investments outside of, say, Wall Street or your traditional custodians to be able to grow your retirement portfolio. Inflation and cost of living increases will threaten to erode your fixed income retirement, so it's really important to, once again, to be proactive and somewhat aggressive in terms of looking at every investment option that's available to you to grow your retirement plan. It is estimated at $4.7 trillion in combined IRA and 401k funds. Out of all those funds, they say only 1% are invested in self-directed retirement accounts and or alternative investments. So that's definitely a number that 1% needs to increase to have full diversification in our retirement portfolios. And this last one is really something that everyone should really take a real close attention to. They say up to you would have to have approximately $750,000 to $1 million in retirement at the time of age 65 or beyond to be able to sustain you through your retirement years. So if you were, depending on what portion of the U.S. you're living in, it will determine whether it's going to be more of the $750,000 versus the $1 million. Be more or less $1 million if you're living anywhere such as California, some of your coastal states such as California, New York, and so on and so forth, that you're going to be needing that $1 million. And that's based on a gross dollar amount, and they usually use that figure over a 10-year span, 10 to 12-year lifespan, based on what they project how long most of us will live beyond the age of 65. So something that you really want to pay attention to is that number, and whether you're working with us and working with your tax professional and legal and your financial professionals, really look at that number or look at your number to make sure that you're close to what you're going to really need to be able to sustain during your retirement years. They say up to 90% of the population is unaware that a self-directed IRA exists, and that would include your attorneys and your accountants, as well as some of your existing financial planners and advisors. And it's no disrespect to that segment of the population. If they're not well-versed or trained in that area of the tax code or have knowledge of that investment vehicle, a lot of times they're not going to know. So as Roger had mentioned, it's really important that you, when it comes to, for example, a CPA, that you're conversing with a CPA who understands retirement accounts and not just your general tax laws or any types of laws relative to your personal taxes. There is a segment of the tax code that most attorneys and or CPAs are not aware of, and it's important that you consult with someone who is experienced and well-versed in that area of the tax code. Your current custodian may not offer what's called a truly self-directed IRA. What is a truly self-directed IRA? A truly self-directed plan will allow you to invest in everything with the exception of life insurance and collectibles. So be careful when you hear the term self-directed, because some custodians' terms of definition of a self-directed plan is that you have options. Yeah, you may have access to 15 to 20 investment options within their pool, but that is not a truly and fully self-directed plan, because once again, with the truly self-directed IRA, you have the option to invest in traditional investments as well as alternative investments. So you have the best of both worlds using this type of plan or structure. Diversification is key. I can't emphasize that more. Once again, the $4.7 trillion in IRA and 401k assets, most of them, once again, are invested in Wall Street. The majority of those funds are invested in mutual funds, a lot of your CDs, annuities, so on and so forth, through your brokerage firms. And once again, that 1% number has to increase in terms of we're looking to really to diverse our investment portfolio. Our motto in the self-directed IRA industry is invest in what you know and understand. These are some of the subcategories of transactions that will cross my desk. I have crossed my desk since I've been in the business for the last 5-6 years. Real estate being the #1 asset class. When we say real estate, that will usually encompass purchasing single-family resident, commercial, multifamily, as well as raw land. That would also consist of those looking to use their self-directed plan to loan, become a bank, so to speak, and loan money secured by real estate, whether it be a first, second, or third deed of trust. Precious metals is another asset class that was pretty popular up until 2010. It's kind of calmed down within the last few years, but I think that's probably going to take off again depending on what happens with the U.S. dollar. Private notes and loans, as I mentioned, that is an option you have depending on the custodian. This is where you really want to be aware which custodians will allow unsecured loans. All of us usually pretty much allow secured loans, but some of them are kind of pulling away from offering the ability for you to offer non-recourse, not a non-recourse, but an unsecured loan. In most cases, it has to be secured by something, usually some form of real estate, personal property. We offer the ability, if you're looking to go beyond just a secured piece of property, if you wanted to secure a loan through a UCC1, that is an option through us as well. And the reason a lot of custodians are beginning to back away, there's some pending litigation with some custodians involving some fraud and some scams involving unsecured loans. So to protect ourselves legally, we pulled back awaiting the decision or the pending outcome of those cases that are in litigation to find out that to make sure that there's not going to be any problems for any transactions we have done in the past. So once we find out where that stands, we may more likely resume offering the ability to offer unsecured loans. But at the present, the only way you can pretty much through us and a lot of custodians to be able to grant a non-recourse loan is through some type of entity such as an LLC or a business trust, which gives you checkbook control. Private companies, whether it's an existing or startup company, you have the ability to invest in a startup company or an existing company using your IRA or 401k. And there's different structures that's available. If you have any questions on that, feel free to give me a call. I'd be happy to answer any questions relative to the different type of structures that's available to you. Once again, invest in what you know and understand. These are just some of the transactions I've seen over the last 6 years that I've been in the business. And once again, I'm sure if you were to contact your existing custodian and ask whether these types of investments are available through your existing plan, I'm sure the answer would be no. So once again, getting you to think outside of the box, look at the list of items that investment options that you have available to you using a self-directed plan. Once again, not limited to this list, but just to give you an idea of what you have in terms of options. Prohibited transactions, and that's relative to IRS Code 4975. Roger touched on that briefly when it came to his presentation. And what that basically encompasses is an IRA cannot engage in any transaction directly or indirectly with anybody or anything considered related to the IRA. So what that means is some examples of prohibited transactions between a disqualified person, which we'll cover in the next slide, what is a disqualified person in an IRA, are as follows: selling and exchanging or leasing property, lending money or extending credit, furnishing goods, services, and facilities. These transaction scenarios are perfectly fine as long as it does not involve a disqualified person. Two key points with the IRAs and using a self-directed IRA or 401k is that there's no self-dealing allowed. So when they say directly or indirectly, there's a list which I'm going to show you on the next page in terms of who you cannot do business with directly or indirectly when it comes to disqualified person. And hopefully this will kind of rein things in for you. So examples of disqualified persons would be, for example, you as the account holder and your spouse, lineal ascendants and their spouses, lineal descendants and their spouses, any fiduciary of the IRA, anyone providing services to your IRA, corporations and partnerships, trusts, estates in which you own directly or indirectly at least 50% interest or controlling interest within that organization. So the last one, what does that mean? If you have an existing business, for example, and you want to do business with your business, with your IRA relative to, say, for example, a loan or investing in private stock. If you and or your spouse combined own more than 50% controlling interest in that company, that transaction would be considered a prohibited transaction and would be deemed, would result usually if it's caught, where your plan would be totally disqualified, taxed, and assessed penalties relative to committing a prohibited transaction. So it's really important, once again, to understand the rules, and if you're not sure, I'd be happy to answer any questions relative to understanding what the rules are relative to any investment structure that you are proposing to use. So in essence, you definitely do not want to mess with the IRS. You want to follow all the rules, and if you're not sure, I'd be happy to answer any questions, as well as to have a conference call with your CPA or tax professional relative to your transaction scenario. So the next step is, once you get your account established, how do you actually fund your IRA or 401k? Putting gas in the tank, as we put it. Transfer is the method of transferring funds out of your existing IRA over to your new self-directed IRA. It is a non-taxable event. It involves you as the account holder completing a transfer request form in which we will sign off and initiate that request per your written authorization. Usually within 7 to 10 business days, those funds are either wired in or sent via check from your existing custodian. A rollover is the method of moving funds from your existing IRA and or 401k or employer-sponsored plan, where usually you have 60 days, whether it's a direct or indirect rollover, to move those funds from your existing custodian over to the new custodian. At 61 days, you would have exhausted your 60-day period, and in which at that time, that method of moving funds would become a taxable event. So it's really important that you adhere to the 60-day rules on a rollover if that's the method you're going to be using to move funds from one retirement account to the other. Contribution, and that's the method of moving funds into your account via monies out of your pocket, monies that usually will be coming from your checking or savings, whatever the source may be, where you're actually making an annual contribution up to the maximum limit that the plan that you're eligible for or choose will allow. And we'll talk about the different plans on the next page. Conversion is the method of moving funds from a tax-deferred account, usually an IRA or a 401k or employer-sponsored plan, any plan whereas you have not paid taxes on the retirement fund. Usually you're going to move those funds over to a Roth. And once those funds are moved over to a Roth, a conversion, you're exempt from the 10% early distribution penalty. You would just be subject to taxation at ordinary income based on your tax rate for the amount that you move over to the Roth. And we'll talk about the benefits of the Roth on the next page. So these are the type of plans that you have available to you using a self-directed plan agreement. So I'm sure a lot of these plans are familiar to you based on just the names, whether you're using them with your existing custodian or just heard through the third-party sources. But these are the plans that we offer that can be self-directed. Traditional, once again, as a tax-deferred account. These are your contribution limits for 2013 up to these maximums. These are not absolute maximums that may be available to you, so it's important that you consult with your tax professional because these limits are up to that amount depending upon your modified adjusted gross income. So if you make too much money, a lot of times you may not have access to make that full contribution, or maybe just a portion may be available to you based on that maximum limit. So it's important to understand what is your modified adjusted gross income. The result of contributing too much money usually will result in a 10% or 6% excessive contribution tax or penalty assessed against your retirement account until that excess contribution has been cured. So it's important, once again, to understand what your limits are relative to the plan type that you will be choosing or eligible for. A Roth account is a tax-free account, whereas after you've had the account for 5 years and you're the age of 59 and a half, you're able to, or I'm sorry, after the age of 59 and a half, you're able to enjoy tax-free growth within that account. So as long as you met the 2 milestones at your age 59 and a half and you've had the account for at least 5 years, any growth that you realize in that account after you've met those 2 milestones, you pay no taxes on the growth. And that's something where a lot of our clients are looking forward to moving either a portion or all of their funds into a Roth account because there's too much uncertainty down the road as it relates to where we're going to be as it relates to income taxes by the time we all retire. So once again, consult with your tax professional to determine whether it's a good idea for you to convert from a tax-deferred account over to a Roth. There are benefits, but once again, the conversion may not be for everyone, and this is where The person who would be best to give you advice on what is best for you would be your tax professional, because he or she has a complete picture of what your financial picture would look like, both present as well as future. The SEP IRA is a tax-deferred account for those who are 1099 or self-employed, and the contribution limit is up to $51,000. Simple IRAs for small businesses with 100 employees or less. This is a small, or should I say, a more condensed version of a 401k. Once again, as long as you have 100 employees or less, you're eligible for that plan through a self-directed vehicle. The 1K or solo K is a form of a 401k for those who are self-employed or 1099 or general partners, where it's a hybrid between a SEP IRA and a 401k. You actually have the option to be able to contribute as an employer as well as an employee. And if you have any questions on how that breakdown works, feel free to give me a call. Once again, that 1K or solo K has what's called a Roth component. You have the ability to contribute into a Roth bucket, so to speak, if that's what you choose once you set the account up. For more information, then feel free to give me a call. Thank you. So here's a checklist of what's required if you're looking to fund a real estate investment with a non-recourse loan. As Roger mentioned, it's very important that you establish your account. Once the account is established, you're going to be issued an account vesting, and usually the account vesting is going to read with us is going to be American Estate and Trust, which is our parent company, the custodian. So it would be American Estate and Trust, your name for the benefit of, and then your account number, which would be your legal vesting. That information is usually going to go on all your contracts, documents, and so on and so forth. Some lenders usually will omit the account number portion, which is fine, but the main thing is to have the bulk of the legal vesting on your contracts and your documents to make sure everything closed timely. You want to make sure also that, as I mentioned, and as well Roger mentioned earlier, is that this plan is set up in the name of your IRA, or if your contract is usually written in the name of the self-directed IRA. All your loan documents will also be drawn up under that legal vesting of the IRA. It will not be drawn up in your name personally, so it's really important, once again, to get that account established to receive that vesting. Provide your lender with an IRA vesting proof of funds for underwriting and approval. So once again, once they get that documentation, they can really move forward in terms of underwriting the loan and making their decision as to where they're going to move forward on that loan. Enter into purchase contract under your IRA vesting. That should be something that's done prior to applying for your loan, because in most cases they're going to be looking for that purchase contract and any related document relative to that transaction to make a loan decision. Forward escrow deposit the title in escrow once the account's established and the purchase contract is approved. Usually within 1 or 2 business days, we'll go ahead and wire or send a check out to the title company to cover your escrow deposit, whichever you have checked off on the box as your method of funding for the escrow deposit. You're going to be authorized or required to complete some internal documents for American Estate and Trust as it relates to giving us permission to sign off on documentation, whether it be purchase contract, loan documents, as well as funding as it relates to escrow deposit, as well as closing funds. So be prepared to complete those documents. But these pretty much are your 6 steps that you're going to be completing relative to using a self-directed plan in conjunction with a non-recourse loan to ensure for a timely close. So what we're going to do, this is a flow chart of pretty much what the process would look like to establish, open an account, fund it, and move forward with your investment. If you have any questions, once again, I'll show my contact information towards the very end and be happy to answer any questions for you. So in summary, IRAs can hold all types of investments, not just securities. Partnerships and split ownerships are allowed. IRAs and solo K plans grow tax-deferred and or tax-free depending on what type of plan that you choose or you qualify for. All plans qualify for partial and or partial transfers as well as conversions. So you're not binded to, if you're looking to do a transfer of funds, you have the option to move all or portion of your funds. If you're looking to convert, you have the ability to convert all or portion of your funds. Can't emphasize more, be sure to establish and fund your account prior to entering into any investment contract. So what we're going to do, here's my contact information. I'll go ahead and leave this up while we'll go through and read off the questions relative to what was typed in for this webinar. And I'll read off the questions, and whether it's relative to what I covered, I'll answer, and if it's relative to what Roger had covered, I'll have him answer the questions. Look like most of the questions here are for Roger. The topic of non-recourse loan is gaining steam because of the real estate market heating up. A lot of people are looking to use non-recourse loans. So the first question is, what are your rates on a non-recourse loan? What are the ranges? So I guess I'll go ahead and let Roger answer that question.
Sure. The rates are very low and competitive now in terms of real estate. We write, just so you know, a 25-year fully amortized loan with no prepayment penalty on it. And there's two options, a 3-year ARM, which we have priced today at 4.25%, and a 5-year ARM priced today at 4.875%. And just as a follow-up on why those are ARMs, I'll explain, if you can allow me 30 seconds.
Sure.
Because these are all portfolio loans. We don't sell our loans, and when that loan is made, it's on our books from the day we make it until it's paid off. And I know what we're paying our depositors today to keep their money in our bank, because we're an old-fashioned bank. Depositors put their money in our bank, we pay them to do so, and then we lend the money back out. Well, I know what we're paying our depositors today to keep their money in here, so I can price my loans accordingly, but I don't know what we'll be paying on CDs and checking accounts and so forth in the future. So I can't fix a loan for 25 years, and just so you understand that, the loan's fixed for 3 years, and then it's adjustable after that, or 5 years, and it's adjustable after that. And again, the rates on those are 4 1/4 or 4 7/8.
Got it. Okay. The next question also looks like it's for you as well. Are there any compensating factors that increase loan to value and or decrease interest rate?
In terms of a loan to value, some things that may, we have a maximum loan to value of 60%, but we may shave that back to say 50% if we determine there's more risk to the bank. And again, because they're portfolio loans, we keep them, we have all the risk. We don't sell these loans, so whatever the piece of property is going in is what we have as our collateral. So sometimes perhaps condos and townhomes, because of they're in an HOA, that's now an overlying entity that is involved by default with that investment. We may say we're only comfortable in 50%. Or it might be a vacation rental, and that's another one that more than likely we're going to cap a vacation rental at 50%. And that is, let's say you buy a property on the Gulf someplace, or on another good vacation spot, and it's a seasonal rental. Well, because we as a lender don't see, that long-term lease in place with the regular lease coming in, we're going to say this one carries more risk to the bank because there isn't a steady income stream per se. It's going to be whatever the management company can produce for tenants. So there are certain kinds of properties, and those are just a couple of examples, that we might say 50% is our max loan on.
Got it. Okay. Now, for example, so I notice your reserve requirement is 15%. So if someone had, say, 60%, 70% reserves, would that be a compensating factor maybe to reduce rate or increase?
We probably wouldn't reduce the rate, Lamar, because I tell you what, these rates we have are I won't call them our stock rates, but they are our stock rates. And these are the kind of rates we're writing on every deal coast to coast. I don't go below that because right now, in fact, those rates, if you look at them, they're about where 30-year fixed rate Fannie Mae, Freddie Mac rates are today. So they're super competitive in terms of the actual interest rate. All I would say is more reserves is good. You probably, or your clients, would have a better chance of getting their loan approved if there were some other factors that weren't so great if they had those reserves. So again, it's common sense lending. More reserves, the better. The more cash flow, the better. And we'll, I can't say we'll keep the rate lower than it is, but we won't raise, you'll get our best rate.
Got it.
This is
okay.
the best way I can put that.
Okay. Well, next question here is, can a non-recourse loan be used for cash out refi on a rate and term refi? So would you guys later down a lot of needed cash for another investment or just need to pull cash out for whatever the reason may be, would you guys allow a rate and term refi or cash out refi?
Yes, absolutely, and that's a good one. You know, a lot of people don't or didn't know perhaps that a non-recourse loan even existed a few years ago or even last year or even now. So what they might do is they may go out and just use cash from their retirement plan with American Estate and Trust or entity they have set up, and they see a piece of property, they want to buy it, they just pay for it with cash. And oftentimes that's the case too if they're buying foreclosure properties or short sales. Oftentimes banks that are selling those will respond to cash offers better than they will for financing. So again, there may be a lot of reasons why an investor may pay cash for a given piece of property up front and close on it, and then later say, well, gee, you know, it'd be nice to pull out 50% of the equity in this thing and use that money to go buy another one or put my money into another asset class.
Well, I know another reason why they had gone that route as well is because in still a competitive market when it comes to multiple offers is that, of course, a lot of times the sellers are not entertaining anything that has a loan attached. So they'll use all cash to purchase or secure the actual deal, and then once the transaction closes, they'll come back and do a cash out refi to get their money out to do something else with it. So once again, they'll use that approach or strategy to secure the deal.
That's exactly right, and I see that a lot, Lamar, in that they want to just close it, get it in, get it done, get it rented, then they come back to a lender and take some equity out, quote unquote, and then reboot their plan with more cash so they can go buy another one or diversify that. But yeah, we can do cash out refis, not a problem.
Okay, and then one thing I also want to add to that as well, and this is for any of the listeners. I know that I have had a few, and actually more, a call last week from a client where her planner advisor did not want her to move funds over because she said, well, you know, if you purchase a real piece of real estate, you don't have any liquidity options. And the reason why I bring that up in terms of the cash out refi option is that in the event that you need additional liquid funds, you do have that option relative to a real estate investment to be able to pull that cash out through a non-recourse loan on a cash out refi basis. So that's something I just wanted to add to this presentation because I know a lot of people are being deterred from making such investments because they fear that, okay, well, in the case of emergency, I don't have that liquidity option. You do.
Yep.
So the next question here, what are the turn times on loan approvals and funding?
Okay. Typically, we can make a decision if we have all the information in about 2 to 3 days. So the decisioning time is quick. We don't charge for loan application. You apply, it's free, only if we like your deal, and we quote you terms after a couple, 2, 3 days, and we will ask you at that point in time for an appraisal deposit, and that's merely what it is. It's an amount that should cover an appraisal in most parts of the country. We order appraisals at that point in time. We go down the line, and we should close in about 30 days total time, start to finish. I would ask if your clients are writing new transactions and they're writing new contracts, probably allow a 45-day close on that contract simply to give the lender and all parties, appraisers, title companies, time to do their work and not run into a deadline, and then we're now looking at trying to get an extension and things like that. So again, my suggestion, write a contract for 45 days. We're going to close at about 30 to 35 though.
Got it. Okay, like 2 more questions here. At least we have time for 2 more questions here. The next one would be, you mentioned that you had, you guys loan to entities as well, or IRA-owned entities. Would you guys loan to an IRA business trust?
Yes, as long as it's funded. The key is the funding of the trust, the funding of the entity must be IRA funds. If that's the case, we can deal with most entities.
Got it. Yeah, and I asked that question because more of our clients are turning to the business trust opposed to the LLC because of, especially here in California, there's a an $800 recurring
The
fee
annual
to the
fee isn't
franchise.
there.
Right. So it's pretty high.
Yep.
So if this is an option that our clients are taking advantage of with the IRA Business Trust. Lastly two more questions here. Can reserve requirements be in another retirement account outside of the self-directed plan? So for example, I know some clients don't want to move everything out of another plan, and they will move over just what they need to acquire the property, secure the loan. But do they have the option to leave their reserves in another retirement account?
And yes, they do, and that's
Okay.
a very good question. I get that quite a bit. But yeah, you can, if you have your performing IRA or retirement plan elsewhere, and you like it, and you're getting some good returns out of maybe a mutual fund or some stuff that's invested in there, I count those as reserves. So you don't have to move everything to your self-directed plan with American Estate and Trust. You could keep enough to complete the transaction as you just suggested, Lamar, and then the reserves could be in another IRA or a retirement plan, as long as that money can be quickly transferred into your self-directed. And that's the only caveat, is that it's
Right.
in an investment class that is liquid. So, for example, a private placement is not a liquid asset, and I couldn't count, let's say someone had $50,000 invested in a private placement with their other plan. I can't count that as reserves because they can't liquidate that in one day and move it over there. There's
That's
typical
correct.
rules on those kinds of things. So private placements, 401k plans that are employer-based that folks can't get at until they leave that employment, I can't count those as reserves. But other retirement plans that you have access to, we do. So again, don't feel like you have to move all your money into your self-directed entity just to satisfy that reserve requirement.
And that's a good point, because you just mentioned it usually has to be another IRA, or if you're over the age of 59 and have it, and it is a 401k, which usually after you hit a certain age, 401k, well, I guess depending on the plan agreement, you could still leave it in a 401k, but as you mentioned, you have to have access to those funds via an employer-sponsored plan, and if not, of course, you can't count those as liquid reserves.
Yep.
Okay, one more question here. And I guess this one here would be, this one here would be directed towards you, and the last one towards me. Will using a property manager versus not using a property manager affect loan decision and or terms? You mentioned in your...
Yeah, let me speak to that a second. You know, here's how we look at this process. Even though the person is not the borrower, their plan is, we really look at what that person's experience level is in real estate. So if the owner of the plan has got rental properties already, they know how to make money in them, we then would have confidence that that person who is directing the retirement plan to buy a rental property would do a good job managing it. There may be times when folks who want to buy real estate don't have a real estate background or property management experience, and they decide it's in their best interest to go ahead and hire a third party, a property management firm. That's actually probably going to be a plus for us in terms of a lender. We like either experienced investors in real estate, managing the properties themselves, or having a management company do that, because then the issues are going to be handled. So that's how we look at that.
Okay. And the last question, I guess that would be more or less directed to me. Which retirement plans are exempt from UDFI or UBIT? And I can go ahead and answer that question. Any employer-sponsored plan, such as a 401k or a solo K, would be plans that are exempt from the unrelated debt finance income tax. And without going into a lot of detail, you can go ahead and give me a call, and I'll be happy to answer that question in more detail. In addition, as I mentioned earlier, there was a webinar we did last week with CPA Lorraine Evans, who went into great detail in terms of distinguishing what is UDFI versus UBIT, or unrelated business income tax. It gives you a breakdown of what the trust rates are, the write-offs and deductions you can take to basically minimize what proposed tax could be levied against your IRA. So it should not be a deterrent if you're looking to obtain a non-recourse loan because of what you're being told of the UDFI or UBIT. There are offsets when it comes to expenses and write-offs that can reduce that amount that you would be more likely assessed responsible for paying. So definitely sit down and talk to a tax professional. That should be part of your due diligence in understanding how UDFI or UBIT would apply to your transaction before making a final decision either for or against the investment. So without further ado, we'll go ahead and wrap this up. Actually, we look like we run out of time here. So any questions we did not answer, feel free to give me a call or email me. Here's my contact information. And I'll real quickly show the contact, or at least the website for IRAlender.com for you to contact Roger to get any questions answered relative to anything we didn't cover today on the subject of non-recourse lending. I'd like to thank everyone for their time and taking out the time of their day to attend this webinar. And you have a great day. Roger, once again, thanks a lot. Great information, and I'm sure you'll be getting calls. Have a great day.
Thank you again. I appreciate it, Lamarr, for the opportunity, and hope it's been a worthwhile experience. And again, thank you. Extend the thanks to American Estate and Trust and AccuPlan. Have a great day.
Okay, goodbye.